Gold continuing its slide to near 6-month lows ahead of the Federal Reserve's first round of tapering that starts next month. But my next guest says don't count out the precious metal just yet. Scott Carter is the CEO of Lear Capital. He's watching all things metal. He joins me now from L.A. Thanks for being with us, Scott. So do you like gold here because you think the economy will fall apart and gold rises? Or do you like it because the economy will grow and gold is a hedge against inflation when the economy grows?
Well, I think the former. I think the economy is weaker than what we're getting in the headlines, Dennis. Thanks for having me, by the way. I think that the Fed's move yesterday was a face-saving move. They're still pumping $75 billion a month into the market. That's $900 billion of accommodative policy. They've announced that interest rates are going to stay low until eternity. All of this is bullish for gold because the economy is weak. The Fed can't get out of the way, and we've got a propped-up economy that's being driven by 12 people at the Federal Reserve.
And yet the economy, if you think it's weak, has been weak like this all year long. I think the past 12 months, average job growth of 200,000 jobs per month. And so why is it that gold, which fell 30% this year, will go up next year if the economy was weak this year as well?
Well, it's a good point. Look, gold's had a bad year. Physical gold has been in high demand, not only in the West, but here in the U.S. as well, by U.S. mint sales. But yet the price is down largely for the paper markets. But when you look at the underlying trends on the economy, Dennis, unemployment is down because of participation rate. That's a big driver. You have record number of people on food stamps. The headlines, in my view, are misleading. Now, I might be the lone voice crying in the wilderness on this, but I think the economy is much weaker. I think the Fed knows it. I don't think they're telling us this, and that's why they have accommodative policies. And I think Janet Yellen is a dove, and I think we're going to be well into 2014 before we see the Fed try to get its mitts out of this market.
Do you have no faith at all in the Fed, Scott, to do a good job of pulling us out of this thing? I mean, the very fact that the Fed cut by $10 billion just yesterday, I thought that meant that the Fed sees that the economy is better than you think.
Well, I think actually maybe I'm a little bit jaundiced view here, but I think Ben Bernanke was taking a bullet for Janet Yellen. I know they've got to trim things back. He took a modest step, $10 billion. Janet Yellen's coming into the new job. She is not going to want to trim things back. So what you have, I mean, let's just face it. The Fed is propping up and creating asset bubbles. It's a bubble-making machine. Equities are overvalued. Interest rates are being suppressed. So you have savers getting destroyed. The bond market is not doing well, and they want to keep interest rates low. This is not an economy that's standing on its own. This is a propped-up economy, and we can't declare the economy healthy until we get the Fed out of it. And that's why I'm bullish for gold, and that's why I think that this is a great buying opportunity, because I think this backdrop will be healthy over the long term for having hard assets like gold and silver and other hard assets like real estate in your portfolio.
Right. Okay. I guess the only problem, Scott, is that if the economy is as weak as you say, then the Fed doesn't taper anymore, and then the economy ends up being okay. But thanks for being with us today, Scott Carter.